Well, tax season is upon us and the deadline is fast approaching. If you own your own home, you want to make sure you're getting every deduction possible, which may make a difference whether you're getting a refund and how much. So, here are some of the deductions as a homeowner that you can take advantage of. The interest that you paid on your mortgage for the past year is tax deductible. The deduction also applies towards interest paid on a condo, a mobile home, a boat, or an RV that's used as a residence. Additionally, this can include a second mortgage, a home equity loan, or a line of credit. As the primary borrower, you can itemize the interest paid over the course of the year as long as your mortgage is secured by your main home or a second home. You can't deduct interest on a mortgage for a third or a fourth home. If you're married and filing jointly, you can deduct all of your interest payments up to $1 million in mortgage debt secured by a first or second home. If married and filing separately, the maximum is $500,000. Just as mortgage interest is tax deductible, so are the points that are paid to lower the interest rate. So if you purchase points as a way to lower your interest rate, you may be able to deduct these points come tax time. Points that were even purchased for refinancing a mortgage can also be deductible, but only over the life of the loan, not all at once. How homeowners who can refinance can write off the balance of the old points and then begin to amortize the new points. If you took out a loan to do some major home improvements, then you can deduct the interest that's paid on that loan. The home improvements must be considered capital investments, meaning any addition or alteration that meets all the following: substantially adds to the value or appreciably prolongs the useful life of the property, it becomes part of the property, or it's permanently affixed to the property so that the removal would cause material damage to the property. It's intended to become, in other words, a permanent installation. An example of a capital improvement that qualifies for a tax deduction would be like adding a new roof, a swimming pool, a porch, or a heating and cooling system to your house. When it comes to property taxes, both the city and the state property taxes are fully deductible from your income. If you have a mortgage with an escrow account, the amount of property taxes that you paid will show up on your annual escrow statement. You also may be able to deduct some of your moving costs if you move because you changed jobs. There are several requirements that must be met to qualify for this deduction, including that your new workplace has to be at least 50 miles farther from your old home than your old job was from your old home. Deductions related to moving costs include travel or transportation costs and expenses for lodging and fees for storing your household goods. I sure hope these 5 tips have helped you find a couple more tax breaks when it comes to filing this year. Just a quick disclaimer: as an American Pacific mortgage advisor, I'm not a tax professional, so always contact your tax preparer for additional information. Thank you very much and have a great day.